Hello, folks. Brandon Chapman with today on Monday's video for TheoTRADE. It is February 26th, 2024, and boy, what a day it is. The S&P, really a small amount of movement, right? We finished down on the SPY 0.37%. The futures looks like we're trading at lows right now, just after the close at 0.44% lower in the session. It did not dissuade as the FOMO trade did continue. It just moved. But one of the things that we're seeing here today, and all you got to do is look at Goog to really see this, down 4.5% on the session, finishing near the low of the session at the close, is that we're starting to kick legs out of this bullish stool, right? Any thought you had that somehow this NVIDIA trade, this broader technology trade was purely, especially in the last week, was about big name investors, right? Institutions pouring into AI because of the future. Today really kind of poured cold water in that notion. The idea is we are seeing the fear of missing out, the FOMO trade, the YOLO trade, you only live once, really pouring in. And today we're seeing it move away from NVIDIA that only finished up about 1/3%. But the fact that Google's leg is being kicked out right now, you look at Apple, Apple's lower on the year. We're just kind of taking these out one at a time. And right now what we're seeing is we're in that volatility, the eye of the volatility hurricane. Right now we're not seeing the sell side really start to pick up, but are we starting to see the cracks? And as you look at Google today, you are seeing the cracks beginning to form. The question is, when does that actually, do we come out of the eye and we start to see the whirlwinds of volatility either to the upside or to the downside? And the reality is, given how much the market has rallied over the last while, we're certainly hitting that stage where the downside pressures may start to be more pronounced. And all we have to do is look at the volatility. So for example, the VIX. The VIX is currently at about 13.77. It's not extremely high. It's not low either. It's just moderately low, moderately high. And given the fact that the market, again, we're basically coming off new all-time highs and that big boost last week on the NVIDIA earnings, it just shows that there's still some expectation of movement in the market. And all you got to do to see that is by looking at the S&P, for example, and bringing up something like an ATR just to see how the volatility is picked up. If we go back to, for example, the January 30 high, just before that last kind of correction day right here on the 31st, the ATR was sitting at about 375. Well, we're currently at about 4.6. What's happening as the market is increasing, going up, the volatility on a day-to-day is expanding. This isn't exactly the type of scenario you want to see, is rising volatility into an apex. As a result, the VIX is remaining relatively high, not getting smashed back down to 12. Now, with the S&P being down slightly today, the VIX was flat on the session. We didn't see any rise in the VIX. If we look at the 3-month to 1-month VIX, just taking a ratio of these two, and then looking at whether volatility is rising back month to front month, or vice versa, you'll see today, since the VIX really didn't go down, didn't go up, we basically stayed flat. And what you're seeing is that currently the 3-month volatility is standing at about a 10% premium to the 30-day volatility. We've come down from these highs at the end of December that was really indicating high degrees of potential volatility in the near future. Now we're sitting back and wondering, the VIX is not getting sold in order to drive the market higher, at least at this point. So what happens right now is the VIX is something to key off, right? If the VIX starts to sell and the market starts to push, this could really be that kind of that buying kind of climax phase where the market may have a chance of coming back around. But we got to be careful, right? Because there is currently higher volatility. We may not get that really kind of clear signal saying, hey, we're forming a peak into this strength. And you're seeing that because of the skew, right? The skew yesterday or Friday finished at about 145. It's come down from 170 down to 145 the last 2 weeks. But the fact is, skew remains high. There's still a high degree of hedging. And so as a result, again, we might be feeling a little bit numb as to the effects of the market. The market right now appears to be relatively delta comfortable. What that means is it's comfortable to see some downside or see it go to the upside. But what likely is happening are we may be starting to see some of the strong hands selling into the weak into this rally. And again, one day does not a trend make, but this is something we've got to watch and watch for other dominoes in the Magnificent Seven to start to experience weakness. Now, we talk about weakness. You're saying, what weakness? Today was a great day. Well, if you're part of that FOMO crowd, it was a great day. And I'll kick things off with Palo Alto. I mean, this was crazy, right? The company just announced earnings last week. The stock drops 20, almost 30%. And the last couple of sessions, we see it getting bid higher. This is one of the premier cloud security companies, if not the premier cloud security companies up there. But how in the world did we get the gap down this wrong that all of a sudden today we were up almost 10% on the session? Bullish option activity coming and helping to goose it for this kind of 1 March expiration, trickling in throughout the day, but amassing some rather significant volumes about every 10 points as you go from 300 to 310 and out to 320. We never saw the 310 and 310 dominoes fall, but what you're seeing is we're trying to create movement on stocks that might be low-hanging fruit. Oh, Palo Alto, it's sold off. That can't be right. Companies like CrowdStrike, well, they made back their losses. Why not Palo Alto? Well, CrowdStrike's yet to announce earnings yet, right? Zscaler is another one, right? Made back all of its losses post-announcement from Palo Alto. Why not Palo Alto? Why shouldn't it get bid back up again? Well, why shouldn't it? Well, they just cut their revenue forecast by 15 to 20%, right? That's rather significant. And these companies are not cheap, just talking in general. And so as we look at technology basically treading water, and you're seeing some of these names rising today. Even companies like MU saw a rather large gap and a run and pushed up to the upper highs around 92.51, about, probably close to 7-8% of the highs today. Again, even in MU and WDC, seeing option activity centered on this 1 March expiration, just buying these out of the money options just steadily throughout the day. No big chunks. We're talking about just steadily, 100, 200, 300, 400 contracts per minute, just kind of pouring in and driving the stock higher. But the thing about this is WDC as well. This can be rather temporary, right? We're talking about weekly options activity. We're not seeing any large prints. So it would be, hey, like a larger institution coming in, just buying 1,000, 10,000 contracts in one print. What we're seeing is just some steady buying throughout the day. And then as we look at MU, we saw it begin to fade. Now, areas where it did not fade, okay? If we look downstream to other companies within the AI space, SoundHound today. You look at this on a 1 day, 1 minute chart, right? We went along, gliding along nicely, and all of a sudden, boom, at about 8:20, we saw the stock surge from about 390 up to about 446. Okay. Now I have a scan over here. This scan is looking at option activity. Okay. Looking out of the money. We're looking for volume being greater than open interest. And as you go down the list here of companies that have the highest percentage move in the technology sector, you'll see Palo Alto, you'll see SOUN, right? SoundHound. Again, what happened in SoundHound? Just look at the option volumes here. 10,000 contracts traded at the $8 strike price, right? You can see it kind of pouring out the 8 March, the 15 March, right? We're seeing just all this volume come in, mostly on the buy side, about 43% relative to 20%, 24% at the bid, but overall 3.7 times the average, much more call than put option activity today. And this helps fuel what's called a gamma squeeze, right? Where the option delta has to be hedged by market makers, creating a squeeze in the price, and then you may squeeze some shorts, etc. And you create these big moves of 46%. So again, what are we doing? We're not moving in NVIDIA. We're moving stocks that we can move, right? Still $1 billion company, I think, in SoundHound. But the reality is it's much easier to move. The apes are out there buying call options in names like SoundHound. AI today, right? Not as pronounced, but still 10.5%. Just go down the scan, right? We have a MSTR today. Well, what's MSTR? Okay. Up 15, almost 16%, breaking out of this kind of flag type formation. You look at the Analyze tab, what does it do? Artificial intelligence, right? So we're just moving downstream in the AI space, areas where it's easier to move if you're a smaller group of investors and you're wanting to speculate. CLSK, WLF, up 15% today. So again, as you go down this list of unusual option activity, you've got HUT, MSTR, MARA, right? BBAI, CLSK. And again, you can see just continuing as you go down. MU, right? Riot, keep going down. ARM, up over 100%, the options there. Unity, we've got all these companies. CRM obviously making it a big move today. It's part of the S&P 100, the second best performer behind Tesla, up 2.5%. Did fade a little bit. There are earnings coming up here shortly on the 28th. So in 2 days, 3 days, I guess, if it's after the close, but you get a sense of where they're trying to bid the market, right? We got Zoom, we've got Canaan as well. We've got Workday. Anyway, there's Wolf in here. Also Wolf Speed, WOLF. It's made a nice move today, 7.5%. Bullish option activity. This is the 28 March expiration out here at the $30 strike price. Again, is this another domino looking to fall, pushing to 30 in Wolf Speed? Again, you just go down the crypto space. Riot, up 17%. Mara, these are high short interest stocks. Mara, HUT, up 17%. CLSK. And what you're seeing is that across this kind of cryptocurrency, Mara, HUT, Riot, CLSK, we're seeing them push, right, these stocks and trying to drive them higher. Now, the great thing about this, if you're trying to speculate in stocks like Mara and most of these other companies, if you have adequate liquidity, it's not that hard to speculate and cheaply, right? You can buy a lower call and sell a higher call and construct a relatively cheap call spread. A 30.31 you could buy for 35 cents at the close today, right? A 30.32 you could buy for 65, 66 cents. A 30.32 is basically get you to right here. Okay, pay 60, you got what? $1.40 of upside. So you could construct relatively high reward risk vertical spreads because many of these companies have what? They have rising volatility. Now, if we look at AI, is that the case? Yeah, for short amounts of time, 18 days out, you can buy the lower strike and sell the higher strike, right? PANW today. And you can see you can buy the lower strike, sell the higher strike. The rising volatility structure makes call verticals relatively cheap. Now, what Don would say is, why not sell this stuff out here, right? Why not sell the calls? It's up to you the tact you take. When you have a rising vol structure on the out of the money calls, it allows you to have the choice. Do you take the option of selling out of the money calls or do you speculate on the upside? Either way, if you are buying call verticals, remember, you have a high probability out of the money of those expiring worthless, especially in stocks like this. So you can construct high reward, low risk, low probability trades, but that's what they are. So position size accordingly, right? Don't put a lot of risk out there because the risk may come around. And one of the risks that are in the market at the moment is treasuries. The auctions have not gone so well. You have gentlemen out there saying, oh, this is the beginning of gold's ascension. Didn't exactly play that way today. Call activity, Newmont, that thing got sold today. But here's the point though. At some point, the amount of debt, and the comment was in regards to potential war and conflict, this is not going to be great for treasury yields. This is going to be a very difficult position if we are going to borrow at the rate that we are, and heaven forbid, if all of a sudden we start to see the climate explode in terms of conflict and increase spending because we're running massive deficits and massive deficits in relation to GDP, about 9.9%. We've just never seen this degree of spending and debt before, except during in times of crisis. And yet we're told that everything is honky-dory. Well, we probably know it's not, but the bond market knows, and the auction today did not go well for 5-year paper. So again, look for the risks of the 10-year treasury yield moving higher. One of the areas of focus last week for me was being bearish utilities and real estate. Utilities did see a breakdown today, about 1.97%. I think retesting our lows, if not breaking lows, if Treasury yields continue to rise, is very real. Real estate as well, turning over today, accelerate down 1.1%, retesting our lows at 37.50, if not lower. You see the steady drip of commercial real estate being sold at massive, massive discounts in big cities. When does it really begin to spill over? And again, rising Treasury yields is one of those things that could precipitate a sell-off. And the great thing about this is, and I usually look at IYR, but you don't need these stocks to move down a lot. 31 days out, a 28 March, you can see on the put side, volatility is rising. You could buy an 86.5, sell an 84.5. $2 spread costs you about what? 75 cents. Risk 75 to make what? $1.25. Close it if you can get maybe a 70, 80% gain on that. So the idea is that you can construct trades that don't require a tremendous amount of downside to be profitable. And by using spreads and using skew in your favor, this is one of those things that can help you do those types of trades. Now, one of the areas I talked about last week with our members was being bullish energy. Now that kind of got slammed a little bit on Friday. We're kind of back up today. But the realities are, if we look at oil /CL, oil prices are holding in here, consolidating. Where are the risks? Are the risks that oil prices move higher or the risks that oil prices move lower? Did you know you can look at the futures market to give you an indication of what they're banking on? Look at the product depth here, /CL. And for this, we're going to look at futures and we're going to look at the shape of the futures curve. Okay. All we need to do is look right here, right? This is the current, next month. Prices are falling. This is referred to as backwardation. Well, why are prices lower in July? Isn't the market saying prices are for oil going to be lower in July than they are today? Well, guess what? That's not exactly the way to look at this. The reason being is that these products are not settled in cash. So therefore, we can't say that the future price is where the price is expected to go. What we can say is that when we consider the price to finance the purchase of oil, store the purchase of oil, and lease it out, there is a net credit in doing so, meaning that there's an implied shortage and that you're able to get a high return on your leasing of your physical oil with which you've secured. And as a result, we have backwardation, which means is the pressure on the back end is going to converge with the spot. It creates upside pressure on oil prices. And so as a function at this stage, the consolidation, what the structure tells us is that the risk is an upside breakout. And if we take a look around and we read the news every day, it certainly looks like that is a real possibility with geopolitical concerns, right? All they got to do is start to shut down the flow of oil or natural gas, and all of a sudden we're in a pickle in terms of energy prices domestically, right? So as a function, the futures market is saying, look, the risk is to the upside. And you're starting to see some flows into energy stocks, like, for example, Oxy, okay? Oxy got the big boost on the Buffett news, and right now we're forming a pennant formation. I drew a fit projection off this little seed wave down here that formed a higher low, and we're looking at about $63 being the upside on Oxy in the near term. And by the way, if we were to break out of this pennant, that would also be the target at around $63. Today in Oxy, short dated, 1 March expiration, 61 strike price being mostly bought out there. Again, we're seeing option flows looking the upside. We have a gamma level here at 61 if we start to break through that could quickly push Oxy to that next level. Okay. Now, if you're considering Oxy, you might give yourself a bit more time. You could go out 53 days, right? The volatility term structure is not working against you. It's basically flat out here. You could buy a 60 and sell a 65 or a 67.5. You could keep out of the money, 62.5, 65. Okay. Buy vertical. That basically encapsulates that kind of just above that 63 target price, or you possibly move it down 60, 62.50 if you want to have a little bit better probability with the break even coming at 61.14. We're currently about 60.5. You need a little bit of upside there, but the reward to risk is greater than 1 to 1. looking at 63 being the target. Devon Energy as well, DVN. So again, do you follow the FOMO crowd or do you follow the crowd? Probably is a little more sophisticated, possibly, with energy and geopolitical risk. Devon broke out. We're retesting that exact same breakout. Double bottom formation, range from 40.5 to 43.5, $3. What's the projection off that? 46.5. That gets you back to prior highs. So the near-term target for Devon would be testing prior highs at around 47, 46.5, right? And so as we look at where we currently stand, today's option trade in Devon was for a 28 March expiration. Oops, wrong one. Out here, 2,600 contracts. So again, we're not seeing the tens of thousands of contracts buying short-term, 1 week, 2 week type options. We're going out here about 31 days buying the 45 strike. And again, look at the volatility, pretty flattish out here, kind of declining at 31 days. You can give yourself a little bit more time, see if that improves. And it kind of does. A 45.50, buy the 45, sell the 50, costs you about $1.20-ish. $50 is right here. But guess what? You break even at just above the 45 strike. So again, go buy deep and wide 1 month 2 strike vertical here. Costs you again about $1.14. Break even's 46.16. If we do break to the upside the next 50 days, pushing to 50, that would maximize. So you risk about $1.14 to make what? About $3.86. So low risk, high reward, a little bit lower probability, but positioned well with oil prices maybe likely to break out higher and helping to lift a lot of the energy space as it did today, up about 1/3%. Well, folks, got to wrap it up there. We'll catch you back on next week's video.